Welcome to today's custom-tailored deep dive. We've got a really fascinating mission today. We are going to unpack a truly remarkable corporate story.
We really are.
Yeah, we're looking at how a legacy, state-backed energy company managed to pull off a massive and highly profitable, I should add, strategic pivot. And they did this all while the rest of the global market was just facing falling commodity prices.
It's quite the paradox.
Exactly. So to figure out how they managed this, we are looking at a stack of freshly released financial documents, press releases, and specifically the Q4 and full year 2025 earnings call transcript from Argentina's energy giant, YPF.
Right.
And these sources are hot off the presses. They're dated February 26th and 27th, 2026. To help break down the mechanics of this transformation, I've brought in our resident expert.
It is great to be here. And what's fascinating here is that YPF has achieved its highest core earnings in 10 years by ruthlessly executing a strategy of, well, shedding old assets to double down on a world-class shale play. They didn't just survive a tough market, they fundamentally restructured their entire business model to actually thrive in it.
And that is exactly why we are diving into this today. Whether you are an investor looking at emerging markets or maybe a business strategist trying to figure out how to pivot a massive legacy organization.
Or just someone who is insanely curious about how the global energy landscape is shifting right now.
Yes, exactly. There is something in this for you. This is a masterclass in corporate transformation, ruthless capital allocation, and really just figuring out how to do significantly more with less.
It really is a textbook case study playing out in real time.
Okay, let's unpack this financial paradox.
Yeah.
Because at first glance, the numbers we are looking at almost seem like a typo.
I know, they really do.
In 2025, the global price of Brent crude oil, which, is the international benchmark for pricing it, dropped by a massive 15%.
Right.
And generally, when the price of your main product drops 15%, your profits take a severe, undeniable hit.
Usually, yes.
Yet, YPF delivered a record-adjusted EBITDA of $5 billion. That is an 8% year-over-year increase, and it's the third largest in the company's entire century-long history. How do profits go up when the price of oil goes down that drastically?
It does sound completely counterintuitive, but it wasn't an accounting trick. It was a fundamental shift in their production and cost matrix. It was completely driven by what their executive team calls their 4x4 plan.
4x4 plan, okay.
Yeah, and to understand this, we need to look at what EBITDA actually means in this specific context. Think of it as their core operating profit. It's the cash they generate from their actual operations before the accountants get in there with taxes, depreciation, and interest.
Right, so it's a pure look at how much money the core business is actually throwing off.
Exactly. Because of that 15% drop in global oil prices, their total annual revenues did actually drop. The top-line revenue went down 4% to $18.4 billion.
Okay, that makes sense.
But here is the critical part. While total revenue went down, their profit margins actually grew. Wow.
Yeah, they expanded from a 24% margin in 2024 to a 27% margin in 2025.
Let me play devil's advocate for a second here. A 4% drop in top-line revenue usually sends investors running for the hills. Why is this a good thing?
Because it's a textbook demonstration of sacrificing vanity metrics for bottom-line resilience.
Oh, I like that. Vanity metrics.
Right. They achieved this by fundamentally changing what it costs them to get a barrel of oil out of the ground, which we'll get into shortly. But they basically stopped chasing expensive, unprofitable barrels just to keep their revenue numbers up.
Okay.
That margin expansion, keeping more profit for every dollar earned, gave them incredible financial flexibility.
And looking in their balance sheet, that flexibility is super obvious. They aren't just making more profit, they are hoarding cash and paying down debt. I saw in the notes that they successfully raised $3.7 billion in new funding in 2025 alone.
Yes, and they tapped international bond markets at highly competitive rates to do it. For example, they issued a 2034 bond at an 8.1% yield. Right.
And for context, that is the lowest rate they've secured internationally in 9 years.
That kind of confidence from international bond markets usually means the underlying financials are rock solid.
They are. And because of this cash generation, they reduced their net leverage ratio to a very healthy 1.9 times by year end.
Let's translate that for the listener really quick. Net leverage ratio is essentially a measure of how much debt a company has relative to its earnings.
Oh,
right?
correct. A ratio of 1.9 means it would take them roughly under 2 years of their current earnings to pay off all their debt.
That's great.
It is. And they aren't stopping there. They've set a target to get that leverage ratio down even further to between 1.6 and 1.7 times for 2026.
For an energy company, especially a state-backed one operating in an emerging market, that is a financial fortress.
Exactly. It provides them with the absolute stability needed to fund their growth engines.
Which brings us perfectly to that growth engine. We have to talk about the crown jewel of their entire operation.
Vaca Muerta.
Yes, the Vaca Muerta shale formation. I admit, looking through the production numbers in these sources, the sheer volume of oil they are pulling out of this rock is astounding.
It really is.
At the start of 2025, YPF set what seemed like a very ambitious goal of producing 190,000 barrels of shale oil per day. I know they beat it, but what did those final numbers look like?
They didn't just beat it, they absolutely smashed it. By December 2025, they were hitting 204,000 barrels per day.
Wow.
To put that in perspective, that is a 42% year-over-year increase in their December production rate.
A 42% increase in a single year for a heavy industrial operation is massive. But how does that compare globally? Like, are they just doing well for Argentina, or is this actually globally competitive?
If we connect this to the bigger picture, you really start to understand why Vaca Muerta is shifting the global energy conversation. The sources included benchmark data from Rystad Energy, which is a major industry consulting firm.
Right, very reputable.
In the energy world, the U.S. Permian Basin is famous for being the absolute gold standard of shale efficiency. It has average lifting costs of $4.90.
And a lifting cost is literally what it costs to lift a barrel of oil out of the ground once the well is actually drilled and completed, right?
Exactly. It's your pure operational cost to extract the resource. So the Permian is at $4.90. YPF's core shale hub in Vaca Muerta is actually beating the Permian.
Are you serious?
Yeah, they are operating at a lifting cost of just $4.40 per barrel.
Here's where it gets really interesting, because it's not just that YPF is operating efficiently. From what I'm reading in the geological reports, the rock in Argentina is simply phenomenal. I saw a metric called estimated ultimate recovery, or EUR. Can you explain what that means in physical terms?
Certainly. Estimated ultimate recovery is basically the holy grail metric for oil producers. It tells you how much total oil you can expect to physically pump out of a single well over its entire lifespan.
And the numbers here are double the U.S. average. A typical well in the U.S. accumulates roughly 1 million barrels. But in YPF-specific core hub in Vaca Muerta, they are seeing EURs reach 1.2 to 1.5 million barrels per well.
The rock quality is a massive inherent geological advantage. Because the wells are so highly productive, it completely offsets any higher initial costs to drill them. And speaking of drilling, the speed at which YPF is learning to operate is staggering.
I saw some notes on a specific block called Barrel Grande. The drilling speeds there were breaking internal records. What does that actually look like on the ground?
Well, in the Barrel Grande block, they managed to drill 540 meters in a single day.
That's incredibly fast.
It is. They finished an entire well with a 3,000-meter horizontal lateral length in just 11 days.
To visualize that for you listening, they're essentially drilling sideways deep underground for nearly 2 miles, and they are finishing that entire process in less than 2 weeks.
And this isn't a short-term flash-in-the-pan play either. They have inventory for days. The sources show that their Vaca Muerta shale reserves grew by 32% in 2025 alone.
32%.
Think about that. Unconventional shale now represents a massive 88% of YPF's total proved reserves. When you look at their total acreage, they are sitting on an inventory of 16,500 gross wells.
That is huge.
At the aggressive pace they are drilling right now, that is a runway that will last for decades.
So they have this incredible, highly profitable, world-class asset in Vaca Muerta. But to put all their energy and capital into that, they had to make some hard choices elsewhere.
Definitely.
I like to think of it like a gardener tending to a massive older tree. To get the trunk to grow stronger and faster, you have to aggressively prune the dead or dying branches, even if they've been part of the tree for a long time.
That's a perfect analogy.
Thanks. That seems to be exactly what YPF is doing with what they call the Andes program. They're actively divesting and selling off their mature, conventional oil fields to become a pure shale player.
And when you look at the math behind these cuts, the strategy is undeniable.
I have to pause you there, though. We are talking about a state-backed legacy energy company. The politics alone must be incredibly complex.
Oh, without a doubt.
walking away from the very assets that kept the lights on for a century, the assets where generations of employees have worked. Sounds like a massive political and operational gamble. Why take that risk?
Because the math made it completely unavoidable. We mentioned earlier that the lifting costs in their core shale hub were $4.40. Well, the lifting costs for those older conventional fields were dragging the entire company down.
How bad was it?
Those mature fields were costing them $26 per barrel to operate.
$26 versus $4.40. That isn't just a small inefficiency. That's a completely different economic reality.
It's unsustainable when global oil prices drop 15%. So by systematically offloading these conventional assets, for example, they recently sold the Manantiales Bear Field for $410 million. The impact on the company's bottom line was immediate.
Right.
YPF's total blended company lifting costs plummeted 44% year over year in the fourth quarter. It dropped to just $9.60 per barrel.
And the executive team noted on the call that if you exclude the assets they've recently sold and just look at the core business moving forward, that total company lifting cost drops below $8.
Pruning the tree is absolutely working. But of course, structural transformation like this isn't free. This raises an important question. If they are making record core profits and slashing their operating costs, why was YPF's free cash flow for 2025 a negative $1.8 billion?
Wait, negative $1.8 billion?
Yep.
Free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures. A negative number of that size sounds terrifying. To a casual observer, that looks like a massive red flag.
It does look like one. But when you dig into the earnings call and parse out the capital expenditures, you realize this isn't a sign of operational distress. It is a highly calculated strategic investment. It's short-term pain for long-term gain.
So they basically spent that money on purpose to accelerate the transformation.
Exactly. That negative cash flow is driven by very specific one-off costs. For instance, they spent roughly $550 million buying premier Tier 1 shale acreage in Vaca Muerta from partners like Equinor to consolidate their dominant position.
Okay, that's smart.
They also made massive capital contributions to vital pipeline infrastructure like the VMOS project, because if you pull all this new oil out of the ground, you need a way to transport it to market.
That makes sense. You can't just stockpile it in the desert.
Precisely. And perhaps most importantly, they paid around $530 million in exit costs to properly close out and walk away from those mature conventional fields we just talked about.
So they essentially paid the penalty to get out of the bad contracts and simultaneously bought up more of the best real estate.
Spot on.
And it sounds like they're going to keep pruning. The management team noted they're planning even more divestments to fund this transition through 2026. This includes the planned sale of a 70% interest in Metrogas.
Right.
They are literally turning legacy assets into cash to feed the Vaca Muerta machine.
The discipline it takes to execute a divestment program of this scale requires an immense amount of strategic conviction from the executive team.
Definitely. So pulling the oil out of the ground at record speed is one thing, but that creates a new bottleneck, processing it.
Yes, the downstream side.
Let's look at how they handled that surge in volume, specifically in their downstream sector, which is their refining business. YPF didn't just break production records out in the dirt of Patagonia. They broke them inside the processing plants, too.
They certainly did.
In the fourth quarter of 2025, they hit a 15-year record, processing 335,000 barrels per day. That is a 99% utilization rate of their refineries. And it didn't stop there. By January of 2026, they pushed that to an incredible 104% utilization rate.
Pushing physical infrastructure past 100% capacity is no small feat. It's one thing to have the raw material. It's another entirely to have the facilities handle it without bottlenecking the whole system.
Right. How do you push a physical, century-old steel plant past 100% capacity without things breaking down?
The how here is a brilliant application of technology. It wasn't just about running the pumps and heaters harder. It was about working much, much smarter. In December 2024, YPF opened 7 real-time AI intelligence centers.
The AI revolution comes to heavy industry.
Precisely. They integrated artificial intelligence platforms directly with their technical teams for 24/7 monitoring. Before this, operators were largely looking at individual industrial units in isolation.
Right.
The AI allowed them to shift to an integrated hub model. It detects operational deviations instantly across the entire interrelated system.
That's a huge, broader business insight right there. It proves that legacy companies don't necessarily need to build entirely new multi-billion-dollar facilities to grow.
Right.
By applying 21st century software to 20th century hardware, you can unlock hidden capacity.
That is exactly the takeaway. By using AI to predict maintenance needs, optimize fluid flows, and detect tiny inefficiencies before they cause actual downtime, you can safely push a physical plant beyond its traditional engineering limits.
You're just removing the human latency.
Right. You are removing the human latency in operational decision-making.
And the results really speak for themselves. Because of this massive technological upgrade, the La Plata refinery, which, mind you, was celebrating its 100th anniversary, won the award for Refinery of the Year in Latin America for the very first time.
And when compared to refineries globally, La Plata went from being an average aging plant to ranking in the top 25% worldwide for efficiency and operational performance.
Best of all, they ran the plant so efficiently that they produced a massive surplus of gasoline and diesel. They were able to completely substitute expensive fuel imports and even start exporting refined fuels to neighboring countries.
It's a perfect synergy. The upstream business pulls more oil out of the ground at a significantly lower cost, and the downstream business uses AI to refine that oil at record volumes and unprecedented efficiency.
Which brings us to the final massive piece of the puzzle. We've talked about crude oil, we've talked about refining, but we have to talk about liquefied natural gas, or LNG.
Yes.
This seems to be the next major frontier for YPF.
This is where YPF is attempting to transition from being a regional South American powerhouse to a true global player in the energy transition. The project is simply called Argentina LNG.
Catchy.
During the earnings call, management laid out the details of this mega project. YPF has just formalized a foundational structure with two global heavyweights. The first is Eni, the massive Italian multinational.
Yeah.
The second is XRG, which is the international investment arm of ADNOC from the United Arab Emirates.
Those are some serious, deep-pocketed players to bring to the table in Argentina.
They are, and they aren't just exploring. They are building a fully integrated project that is targeting 12 million tons per year of liquefaction capacity.
12 million tons.
We are talking about dedicated gas pipelines spanning the country, two floating LNG vessels, and massive onshore infrastructure.
What are the economics of something on that scale?
Yeah.
Building floating LNG facilities isn't exactly cheap.
No, it's not. It's an estimated $20 billion capital expenditure project. And that doesn't even include the upstream costs to drill the gas in the first place. They're aiming for what the industry calls a final investment decision, or FID, in 2026.
$20 billion is a staggering number. But the key takeaway for you listening is why these global partners are flocking to Argentina to spend that kind of money. Rystad Energy reports that this Argentina LNG project has one of the lowest break-in prices of any pre-FID LNG project globally.
Because the natural gas coming out of Vaca Muerta is so abundant and so incredibly cheap to extract, it gives the entire massive infrastructure project an economic cushion that very few global LNG projects can match.
Right.
It positions YPF to be a major supplier of energy to the world well into the 2030s and beyond, competing directly with projects in the U.S. and the Middle East.
So what does this all mean when we look at this stack of earnings transcripts, press releases, and financial reports? YPF's 2025 is an absolute textbook example of how a legacy company can completely reinvent itself. They didn't just weather a storm when global oil prices dropped 15%. They used that market pressure as a crucible to cut the fat. They sold off the heavy, expensive conventional fields. They modernized century-old infrastructure with cutting-edge AI to unlock hidden capacity. And they pivoted hard and fast into their world-class Vaca Muerta shale assets.
The core lesson here extends far beyond the energy sector. It's really about the immense power of focus.
Yeah.
For decades, YPF was trying to do everything, managing declining conventional fields alongside new shale exploration, trying to keep everyone happy. In 2025, they made the definitive, painful choice to be exceptional at one thing, Vaca Muerta shale, rather than being mediocre at many things.
Which is incredibly hard to do.
It is. That kind of corporate discipline is rare, especially in state-backed enterprises. And as we've seen from the record margins, it is incredibly lucrative.
It's a masterclass in focus. And it leaves us with one final provocative thought to mull over. During the Q&A portion of the earnings call, YPF CEO Horacio Marin made a stunning statement. He said his personal goal is for YPF to have exactly zero conventional oil production by the end of 2026.
Zero.
Zero. They are entirely walking away from the assets that built the company over the last 100 years. As one of the world's first state-owned oil companies successfully transforms into a pure shale player, it makes you wonder. Will other national energy giants globally be forced to make similarly drastic, painful pivots to survive the shifting economics of the next decade?
It is certainly something to watch.
Thank you for joining us on this custom deep dive into the transformation of YPF. Keep questioning, keep exploring, and we will catch you next time.